time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
So this actually was a question that came in from one of our clients in our US chat session in April. I thought that we'd cover the stock again after it had a recent bump here. So Marvell Technology Inc. MRVL on the NASDAQ, currently trading at a price of about $65.50, has a $5.6 billion market cap and a dividend yield of about 0.4%. So the company provides data infrastructure semiconductor solutions spanning the data center core to network edge. And the company develops and scales complex system on a chip architectures, integrating analog, mixed signal, and digital signal processing functionality. So essentially what that means, the company offers a portfolio of Ethernet solutions, single or multiple core processors, custom application specified integrated circuits, and so on. So essentially it is, a hardware company. Now, year to date, the stock is up about 73%. And just in the last week, it is up 46%. And let's take a look at what is driving the share price. So, number one, following the release of its Q1 2024 results, the CEO, Matt Murphy, commented that AI is acting as a great growth driver for the company, stating that AI has emerged as a key growth driver for Marvell, which we are enabling with our leading network connectivity products and emerging cloud-optimized silicon platform. While we are still in the early stages of our AI ramp, we are forecasting our AI revenue in fiscal 2024 to at least double from the prior year and continue to grow rapidly in the coming years. And to put this into perspective, in their conference call, they noted that in fiscal 2023, they estimated that their AI revenue was approximately $200 million. So if they expect it to double from that 200 million to at least 400 million, that would be adding an additional 200 million in revenue for the year, or on a quarterly basis would equate to about 50 million in additional revenue. So that would mean that overall, this growth in AI should contribute to about or to under 4% growth per quarter. And again, that's based off of Q1 2024 revenue, which was essentially at a low. Now, he also commented that revenue growth is expected to accelerate in the second half of this fiscal year, accompanied by gross and operating margin expansion, which will be good if the company can achieve. Now, number two, the company's Q1 2024 results did come in better than management's Q1 revenue guidance of 1.3 billion, and it also beat analyst estimates, even though Q1 net revenue declined 9% year over year and non-GAAP diluted income per share declined 40% year over year. So let's take a look at those actual results here again for Q1 of 2024. Now, net revenue came in at 1.322 billion, a decline of 9%, like I just said. Cash flow from operations was 208.4 million, an increase of about 7% year over year. GAAP EPS was a loss of 20 cents, which was essentially flat year over year. And adjusted EPS was down 40% to 31 cents per share. And the company now has net debt of about 3.6 billion and a trailing net debt to EBITDA multiple of about 2.4 times. And as you can see on the table, I have also included the company's Q2 2024 financial guidance, which at the midpoint has revenue at about 1.33 billion, which would represent a decline of about 12% year over year. And GAAP EPS is expected to be 16 cents, a loss of 16 cents. And adjusted EPS is expected to be 32 cents, which again would be a decline of about 44% year over year. And using the company's Q2 2024 guidance on a forward basis, the business trades at about 40 times adjusted earnings. And if we take into consideration the company's debt on a trailing enterprise value to cash flow from operations basis, the stock trades at just over 7 times cash flow. So let's just quickly look here to see how the company is adjusting its net income. And realistically, the primary thing that I wanted to point out here is that it is adding back significant stock-based compensation. So I just wanted to highlight that to people. And finally, just to conclude on Marvell, Now, the stock is trading at 40 times adjusted earnings, while revenue and EPS are actually down year over year. The company has a net debt position of 3.6 billion and a net debt to EBITDA multiple of 2.4 times, which I do believe is sustainable, but it's getting up there. Now, the company believes that AI will fuel growth going forward, which may be true, but in my opinion, the anticipated growth for fiscal year 2024 isn't justifying that 40 times adjusted earnings multiple. And I really think that the recent move in the share price is a bit unjustified and being led by the hype around AI. Now, if I'm just going to add one more thing, like Aaron was talking about with NVIDIA, is this company is generally cyclical. If we look at historical financials, we saw the company post 3.6 billion in revenue in 2015. We saw that come down to about 2.3 billion in 2017, came back up to about 2.7 billion in 2020. And now we have seen it start to take a bit of a tear, or the growth has been on a bit of a tear for revenue. But again, we have seen revenue and the business tend to be cyclical over time.
Yeah, 40 times adjusted earnings for what's a cyclical stock, and with debt as well. I mean, 2.4 net debt to EBITDA, that's not outrageous, but it's certainly, I mean, there's leverage there, right? It's not like it's a cash rich company like we see with some of these other, software. NVIDIA as well, I believe, is cash rich. So it's, I mean, to me, I don't see I don't see the value here.
Yeah, I agree. I think that it's just, been the recent pop has been driven by hype. Like we were talking before, I just Command F on a Mac to just find, and there was, I don't know, probably 70 times that the company referenced AI in their conference call too. So, there's a lot of companies right now that are jumping on the AI bandwagon, and I mean, this is kind of even just an AI themed podcast episode. But yeah, I think that that's primarily the reason. And yeah,
I mean, I know we're looking forward, but you said an 8% decrease in revenues, and the stock is up significantly this year. Again, we're looking, the market's looking forward on the company, but it's trading at premium multiples. The industry has cyclicality to it. I think it's trading at significant premiums right now off of some AI hype. Again, this is not saying that AI is not going to change the world. Likely it is, but is this going to be sustainable? Is 40 times earnings a good, and that's adjusted earnings, a reasonable price to pay for this company, which has historic cyclicality? Time will tell, but likely not at this point.